Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Neuhaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Total Convexity, Episode 6 is recorded on the 3rd of November, 2023. I'm your host, Henrik Neuhaus. Joining me is my co-host, Jim Wang. I'm glad to return with Episode 6 of our podcast series. In the first episode, we discussed our investment and analytical framework, and we recommend new listeners to start out by reviewing our first episode, as the explanation of our framework lays the foundation for the subsequent episodes. Since then, we have discussed interest rates, the US dollar cycle, gold, and fiscal and monetary policies. What do you want to discuss this week, Jim?
Hello, everyone. I'm very glad to return to the new episode. It's another week, and let's see. On October the 6th, we discussed interest rate and the treasury securities. As part of the discussion, we discussed the liquidity impact on U.S. Treasury bond market and the overall implication on the broad financial market. And I would say that's the key driver for the financial market since summer, since July this year. Now, this Wednesday, Treasury released its quarterly refunding document. It's also called QRA. And there's some updates on Q4 Treasury funding plan. And maybe we should spend a little bit of time on that and get an update on the liquidity. What do you think, Henrik?
Yes, I think that would be very good because, yes. So I think that most people would be confused by why the Treasury refunding plan would have anything to do with liquidity, actually. Perhaps you could help us by refreshing our memory about liquidity, which we previously discussed in our first episode. What is it exactly, and why is it important? Jim?
Yeah, so like you mentioned, we discussed our framework at and so we recommend new listeners to listen to the first episode where we lay out our framework. And we think that there's numerous factors that we consider in order to handicap the capital market. And the liquidity is one of the most important things. So generally speaking, when the liquidity is increasing, that is positive for the financial asset. When I say financial asset, is bond, stocks, commodities, gold, everything. Okay. So overall level of the financial asset will increase. When the liquidity is tightening, and that will have a pressure for the entire financial asset. And the distribution of the financial asset, distribution of the pressure, however, is not even. It will really depend on the relative valuation of the asset prices priced relative to the future growth and future economic growth and the future inflation. In addition, it will also depend on the relative valuation between the different asset classes between themselves. So when the liquidity is tightened, those overvalued asset and those who were mispriced for the future growth and inflation will suffer more. Okay, and so that's why the liquidity is very important. Now there is numerous measurement of liquidity, and it's very difficult. There is no single cut. And for us, we have a number of things that we look. One is the change of monetary base. Okay, we basically look at the change of a monetary base minus change of inflation minus change of GDP, and that real GDP, and that is basically the amount of money that is ready to be deployed into financial market rather than real economy. And then the impact on the financial market will also depend on the size of the increase relative to the size of the capital market. So we'll divide that by the market cap. Okay, so that's one measurement. The other one, we also talk about liquidity can come in because of increasing leverage. Okay, so we talk about, for example, the volatility target fund, right? When the volatility decline, they will lever up. When they lever up, there will be more demand for the financial asset. So leverage can create liquidity out of thin air. And the third one is U.S. Treasury funding gap. And that one is not as clear as a lot of people were thinking. And it's actually one of the key mechanisms for the QE to work, to inject liquidity into the system. So that's just so the Treasury basically need to issue debt. Okay, so there's a supply for the market, and that debt need to be absorbed by the market. Okay, so the increase of supply will have downward pressure for the liquidity. Okay, now then they have a demand side. Okay, the demand side, typically if the demand is coming from non-economic buyers, then that's injection of liquidity. And what are the non-economic buyers? Those are foreign central bankers, okay, reserve managers, all right, and when the QE time, it was the Federal Reserve, right? So if you have a more demand for the Treasury, and then there's that injection of liquidity, okay, into the system. So the supply and the demand of Treasury securities, we call it the U.S. funding gap, and that have direct impact on the liquidity of the overall financial market. So that's kind of a brief kind of overview, Henry.
Okay, well, that makes sense. Now, as you mentioned, back on October the 6th, when we discussed interest rates, you said you were worried about the liquidity backdrop and explained the implications for interest rates in various asset classes. Now, before you give us an update on liquidity, perhaps you could take a few minutes and explain exactly how all the pieces work together?
Yeah, sure. Let's go there. So I think on that day, we basically explained the liquidity situation at the time was very tight because of the supply and the demand imbalance. So we talk about there is a 2 trillion budget deficit, and there's a significant refinancing need as well. We also talk about the lack of demand because of those. By the way, we are not the only one. Okay, so everyone have noticed this, and everyone have been talking about this. Is there's not much demand because the Fed was doing, instead of doing QE, they were doing QT. And the foreign buyers basically dry up, and we also talk about that because of the inverted yield curve, the hedging cost is very high. Therefore, even the U.S. offer very high interest rate that overseas, Japanese and European investors are not interested because of the high currency hedging. Therefore, there is not much demand for the coupon treasury. And because of that, that result in the kind of a tightening of the liquidity. But what we differ from a lot of other people is we pointed out that the tightening of liquidity will be distributed across the different asset classes and based on their relative valuations, right, to the growth and inflation and among themselves. So we pointed out the stock will be also very more vulnerable to the downside. And obviously, if the growth have slowed down a lot, earnings start to decline. Stock will fall much faster than bond. And if growth is robust and earnings was very strong, and then the stock may still support it, and because of the earning component, but the valuation will come down together with bond. So that's kind of the dynamic that we're explaining. But you can see, what has happened in the past 1 quarter, right? And both stocks and the bonds have come down because of this tightening liquidity.
Right. Yeah, I think you're spot on there. And you mentioned in this past quarter, because since July, nearly all financial assets have been selling off over this period. But still, something changed this Wednesday when the QRA came out, and both bonds and stocks have rallied. So what exactly is the information in the QRA, and how does it relate to these recent rallies in the past few days? Jim?
Yeah, so for those people who do not know, the QRA is a quarterly refunding. I think it's called appendix or analysis. It's an abbreviation for that. But in any case, every quarters, and the Treasury will release their estimate of the amount of the bond that they are going to fund, and how much, and then kind of the breakdown. So I think on Monday they release kind of the amount of the debt that they want to fund, and I think a lot of people were expecting more. It's probably driven by a lot of people expecting probably will be higher. They want to build a higher TGA, but looks like they maintain the TGA balance the same, and the amount was diminished by about 75 billion. But I think that's not a big deal. I think the market really caught kind of off guard on Wednesday, where basically kind of the breakdown when how the Treasury want to issue debt. So I mean, I pulled it up and just for people to look. It's basically on the top here. Here is the new bills to issue is about 437 billion, and also the new money, meaning the new money that need to be raised is about 776 billion, right? Among the 776 billion. 437 billion is through T-bill, and 338 billion is through coupon issuance, right? So that's a significant reduction versus people's expectation, because people were expecting a lot more coupon issuance, right? Note we also have a 582 billion here, and this is just for rolling the maturing debt. So when the debt mature, because the U.S. Treasury is running permanent deficit per se. Therefore, for whatever maturing debt, you need to roll the debt. You need to have a new debt to pay off the old debt, right? And this one is more kind of liquidity neutral, right? The new money is basically it's going to be negative for liquidity. But if you fund it through the T-bills, and then the liquidity kind of demand will significantly reduce. And this is especially true that we still have 1 trillion in the reverse repo facility. Just note that the reverse repo is the money who park at the fund. Most of the participants are money market funds, right? And when the money coming out of the reverse repo, and that's the injection into the financial system. That come into the financial system is increase of liquidity. So that can be funded by the reverse repo. Now we still have 1 trillion to go. So I think this 338 billion, okay, is a still very significant number. All right. Remember, when Fed was doing QE, during the QE1, QE2, QE3, that's about monthly kind of the purchasing, right? So 338 billion is a very significant number. However, versus expectation, this is a big relief. And because of that, I would say, immediately after QIA release, long bond have the biggest drop. I say, that we have seen in the past, in the recent months. At the same time, the stock has a big rally. So Now, we can have a separate discussion on this one, is that, people talk about the correlation, right? And, bond and the stock, they move in the same direction. And statistically, you can observe that it's true, but there's an inherent reason for that. And the reason is because bond is driving the price of stocks price right now, okay? In the absence of recession. When the recession hit, the earnings and the growth that will drive the stock price. And for now, the stock is still driven by the bond, the overall liquidity. So you can see here that both bond and equity have a big rally together. So I think the implication for this one is long bond yield may have, I think that certainly the probability is very high. We have one of the major tops of long bond, okay? And it's possible that top is the top of the cycle. I'm saying it's possible because, this liquidity thing is just one variable, and you also have to consider the growth and inflation. We think growth and inflation overall is coming down. However, in the near term, it's very difficult to handicap, 1 month, 1 quarter. But the overall projection is the growth is going to come down with high probability of recession, and inflation is going to come down. So from that perspective, the top that we have seen in the past few weeks could be it is the one of the major top in our mind, and could be the top, all right? In terms of the stock price, that, because people were priced very, tight liquidities, and now there is a signs of relief, and I think they have oversold conditions, sentiment was very bad. Across all the backdrop, and the seasonality is positive. But by the way, the presidential election cycle, following the presidential election cycle, and typically this time period is the best time for stock to perform. So those are the temporary tailwinds. Now we still have the headwinds. The headwinds is the financial conditions overall is very tight, and then the probability of recession is very high. So if you put all these puzzles together, and depending who you are, and our expectation is that stocks could be supported into the Q4, and obviously we cannot forecast the levels, and we have to follow it, based on what we see. But we think that this will peter out, and probably sometime this year or beginning of the next year, and then we will have a bigger movement probably towards the downside. That's kind of in terms of general implications that we are seeing here. Now there's another component here is the Treasury is going to engage Treasury buyback. And by the way, I want to come back here is that Treasury should be supposed to be very predictable kind of forces in terms of the breakdown of the coupons and the bills and etc. And what Yellen is doing right here is actually they were doing the monetary policy right now by changing the composition of the issuance, right? By choosing more T-bills than coupons, they are effectively easing, right? They are effectively doing the operation twist, right? Now, one of the things people we talk about here is the Treasury buyback program they're going to roll off next year. Now, the Treasury buyback program, what is that? Is basically, we have the Treasury have over the run and on the run, right? And, off the run is basically less liquidity. On the run, have more liquidity. So the Fed is basically saying they want to improve the liquidity. They will buy off the run, right? And so that to improve the market liquidity. And then simultaneously, they will sell. When you sell, is by definition is on the run. And theoretically is liquidity neutral because you issue new bond, and you purchase the old bond. And that is assuming they are doing the same maturity. But if they are buying duration coupon bond, okay, and off the run duration coupon bond, and they are issuing more short dated, or T-bills, then that is basically effectively doing operation twist. Effectively, Treasury was doing the job that the Federal Reserve was doing, which is operation twist, meaning they want to kind of relieve the pressure of the long-dated Treasury yield, and instead of issuing more more T-bills. They supposed not to do that, but who says that we cannot prevent them doing that, right? So that's another dynamic that we can talk about. Eric, after you.
Yeah. Okay. Interesting. So now, at the time when we discussed interest rates, which was a few weeks ago, I think the 2-year yield was 5.08 and the 10-year traded at 4.8 or something. And you argued that interest rates and US Treasuries represent a buying opportunity. Now, after that conversation or that episode, yields went a little bit higher, but they have all now come down significantly in the past few days. So where do you think we'll go from here?
So this will be a good, we just have the Fed meeting, right? So this may be a good starting point. Let's touch upon on Fed meeting. So this month we have a Fed meetings, right? And this week, I'm sorry, and also on Wednesday. And the Fed, as we all know, Fed put the rates on pause, and it's not surprising. It's basically priced by the market already. I would say if you look at the econ data, and the Fed, may hike, okay, because the inflation, appears to be sticky, and the lagging economic indicators they show, pretty robust labor market, right? But because of the tightened liquidities, right, long bond has gone up a lot, and stock has come down a lot. So from a financial condition perspective, that has already been tightened a lot. So the Fed basically want to unpause. They think that the long bond have tightened the financial condition for them, right? Then looking forward, I would say it's if the long bond didn't come down, if the stock don't rally, and I will say Fed is basically done, right? But if the long bond have a significant rally, how significant is significant, and which we can discuss. But I think it was 10-year below 4.5%, right? Stock make maybe higher than July or matching high or above that, and then I would say that that will be a significant easing of the financial conditions, right? And then I think if that's the case, there's a possibility of another Fed rate hike, right? I would say if that happens, right? Now, there's another variable, which is the economic variable. But if the financial conditions have easing a lot, and if the unemployment rate start to go higher, I mean, we just have the job number come out. It was not good. Okay, unemployment is starting going higher, and the jobless, the non-farm payroll is coming down, and there is, and if the inflation comes down significantly, I would say they may still weigh in between these two: weakening economy, rising unemployment rate, and the falling inflation versus the easing financial conditions. They may continue to pause. So all I'm saying here is that you need to look at what's the financial asset conditions, and you also need to look at the economic development in order to handicap whether they're going to hike or not in December, and that may have some impact on the short rates. But if you look beyond that, and I would say I think if even the Fed hike the interest rate for the front end, it's not going to have a significant impact because that probably will be the last one, last hike. Or so I think whether they will hike or not, I think it's not material. From that perspective, I think the front end of the race represent a very good, very good buying opportunities. In our base case of a recession, they will perform very well. If we are wrong, if there is a soft landing, and then I think they can continue to perform. I mean, only if the economy reaccelerates to the upside, then the short-dated rates will, you will lose money on that, which is not our base case, which I think is highly unlikely. Now, if you look out, of the durations, right? We talk about, the overall supply and the demand imbalance will have a downward pressure on the price. In other words, upward on the yield. And I think a lot of people overreact too much about the supply and demand. And by no means these are very important. But we pointed out two nuances, right? One is the supply and the demand is going to have an impact on the overall, the financial asset. So it's not only on Treasury, but also on all the rest of the financial asset. Now, we think Treasury is, the stocks is overpriced versus a bond. Okay, we think growth is overpriced versus bond as well. And I think the yield has arrived at the long bond has arrived at the yield level where it's become attractive for the asset allocators. Okay, and it's very reasonable, right? In the past, since July, as you mentioned, when the bond yields started to rise, stock was selling off until in the most recent, weeks, as you can see, the long bond was basically hanging on the top level, but the stock have bigger decline. So, and if you look at a lot of the, I say corporate pensions, right, and their discount rate is called long duration corporate bond, and they invest in the diverse asset classes, right? So you can think about their liability is discounted by the long duration corporate credit bond. And their assets are stocks, bond, and a combination of everything, right? So they are fully funded. Okay. Now it does not make sense for them to take the risk, right? Because their main business is not to generate the money through, the financial market, right? So it just makes sense for them to reduce allocation into equities and the risk asset and increase the allocation to the fixed income. So I think that demand is coming, right? And that is going to be very significant, and that can lead to the demand for the treasury yield, for the treasury bond. So the second kind of thing people misunderstand between the supply and demand, we talk about this, the main driver for the interest rate is basically the growth and the inflation. Now people say Fed have control of short dated, and the long dated is out of their control. It is not true. Fed have control, have long short dated. That's because Fed choose to control the short dated. Fed choose not to control the long dated. For example, BOJ choose to control long dated. Fed choose to control long dated by doing the QE during the after financial crisis. Now Fed choose not to do it. Fed can control the Fed can control the interest rate across the entire interest rate curve, period. Okay. Now, the interest rate, forward-looking interest rate, is nothing more than a combination of the integration of forward-looking policy rate, right? So if you can look at a forward policy rate 1 year from now, 2 years from now, 3 years from now, and then you integrate them together, you get a longer dated yield, right? So the treasury supply and demand certainly will have impact in terms of the cash versus that swap market. Cause the spread to widen or to tighten. But the primary driver continue to be the growth and the inflation. Okay, so I think that's the second nuances that we want to point it out. Okay, Harry.
Yeah, absolutely. So this was a lot of information. Now, on a very practical and applied level, how could our listeners use this information? What could they do with this information?
So first of all, we don't know who our listeners are, right? And they have different types. So I would say, if you are a longer term asset allocators, right, for the family offices and pension endowment foundations and etc., right? And I would say cut down the allocation to the risk asset, increasing allocation to the fixed income is the right thing to do. Now, which tenor you want to do? And I would say depending whether you do this, whether you can lever or not. If you can lever notional amount with the same risk, then I would say you can lever 2 years. You can lever up 2 years investment because I think a year will come down more. See, for example, if you lever 2 years 4 times, and that will be the similar for you to buy 1 unit of 10 years. In other words, you can spend $1 by 10-year bond. You can spend, you can lever that. You can lever up by 4 unit, right? With notion of $4 of 2 year. Equivalently, you have the same. You have a similar durations, and I think that will be a better way to do it. And obviously we like front end and to have enough cash, right? But if you cannot lever, you cannot lever, and I would say longer dated year bond is fine, and they probably will rally during the recession time period. And although the yield will come down less, but the duration will help you, right? And if you are fast money, right? If you are very, I would say that apply to the retail money, the retail people as well, right? And if you're fast money, and obviously you can do the leverage, and I think the curve is also a very interesting play. And I'm saying that with a good amount of confidence that the curve flattening is ending, and now we are in the regime of curve steepening, probably for the next 1 to 3 years. And I do not know how fast the recession happened. Maybe 1 year, 2 year, maybe 1 year, or maybe 1 year, 3 year. But in the next few, in the future, I think the curve will steepen, and that probably will be led by the drop of the short-dated yield. So you can contract trade on that, and the liquidity impact from from timing perspective, I would say, like I said, the liquidity, backdrop, is positive for the durations because of these change QRAs. However, if the stock continues to rally, things are very strong. I mean, there's a chance that the bond price can go higher because Fed says, hey, liquidity condition easing too much. So there's a chance for the bond to technically rebound, and I would say that's a buying opportunity again. And obviously, if economic data does not cooperate, and if the unemployment rate, start to go higher, and the inflation comes down pretty quickly. By the way, I would say this is a plausible scenario, and it can happen. And I think it will eventually happen, but I think in the near term, it actually can happen based on our reading. And in that case, we may not have a rebound, and we will have a very shallow rebound. So that's kind of what I'm seeing here.
Okay. So now on Wednesday, so we had the QRA announcement. We had the Fed meeting, the announcement from the Fed, and the press conference. But there was also a third thing, I think, that happened almost simultaneously. The Bank of Japan was up to something.
Yeah, that's right.
What was it that it did?
Yeah, that's right. So we also had the BOJ meeting. Well, I think we should do a separate podcast for both on the yield curve and also on BOJs and discuss the implication. It's very long. I think that, it's probably worthwhile a separate discussion on them. But basically, BOJ's action is overall of the world financial market is very, very, very big, because when the BOJ was doing QE in the past, the money is not staying in Japan, and they were flowing all over the world. Okay, and that was one of the key liquidity driver for the financial asset all over the world. Now we all know that once the Fed started to tighten the monetary policy, the rest of the central banks all have tightened. At the time, actually, we think that represent a good window of opportunity for Japan to do the same. But I think they missed that opportunities, and a lot of people were hoping that they will normalize their kind of interest rate policy, which and we are basically adamant that Japan will never normalize their interest rate policy because they cannot, because of the debt level, and they, if they normalize, the entire revenue will be to serve the interest rate cost. So they were just talking the talk. The central bank will have to come here, monetize that debt permanently, period. Okay? Now, a lot of people has misunderstood. I think, a lot of people are talking about the BOJ where, in the past, they basically, they were pegging the rate, so for the yield curve control. And most recently, they increased the, the cap to 1%. And once they increased the yield, and first to 0.5%, right? Now it's, and then the last meeting, they curved the cap to 1%. So, people think, okay, that's the, because they are widening out and there's, kind of more incentive, that will be, they do not need less QEs, therefore is less liquidity, and etc., which is actually not true. The opposite happens, okay? Because when they remove the yield cap, right, and and the selling pressure actually increased. Okay, and they have to do more QE. Just think about it. In the past 2 years, in last year until this year, if you add them up, I mean the QE amount is larger than any time they have done before, and that's after they release the yield curve cap. The reason for that is because if you're a bond investor and you see them to release the yield, kind of going to increase yield by 50 bips. The next thing you think, okay, they are starting right now, 50 bips. The next is 1%, and then it's 1.5, 1. Let me just sell everything, and then let's just sell right ahead of them, right? And then the BOJ is basically saying, no, I'm going to control here, and then they have to come here to do more QE, right? And the problem is because of the currency hedging cost here in the US, right? So the amount of QE is not coming to the United States. I mean, of course, some of them leak here, but a lot of them come here because if there is a positive carry after currency hedging, and there is no positive carry after currency hedging, and therefore a lot of the money, the liquidity stayed domestically, and that explains significantly why the Japanese domestic equity rallies. Another rally at the backdrop of the currency. Okay, so I just walked through this very quickly to give you a background, and then we have a last meeting. Basically, they use 1% as a reference point, and in other words, they can tolerate for this yield to go above that. I think if you look at a currency kind of reaction, right? The currency went above 150, right? So I think that people do not think they are credible in terms of normalizing the interest rate policy. I think Japan is on the permanent way to monetize their debt, and there will be no normalization. So I think we can just touch upon here and just basically pointed out some of the misconceptions that people have, and then I think probably makes sense for us to talk about more into the details about BOJ and the impact on the globally for next time. What do you think?
Well, yes, it certainly sounds as if the BOJ is material for a very long episode. So anyway, okay, so I think we've come to the end of this particular episode, the episode 6 of Total Convexity. So let's try and summarize what we have been saying here. So liquidity is one of the most important factors that drive financial assets. The big picture is that liquidity is very tight relative to history because of the structural supply and demand imbalances of treasuries, of the treasury needs. In the near term, however, because of the treasury's maneuvering, let's say, with debt issuance, we could see a temporary liquidity relief that outweighs market expectations. Therefore, bonds and stocks could potentially rally from here, particularly given the extreme sentiment and positive seasonality. And at least for bonds, there is also the possibility, of course, of a geopolitically driven flight to safety. You never know when these things can happen. Of course, this is just one variable. Economic and market developments may also change this projection. Now, if longer maturity bonds were to have a significant rally, that is, significantly lower bond yields may counteract the effects of the recent rate hikes, and the Fed may feel obliged to further hike the overnight rate at least once. Now, however, if inflation comes down significantly, and if the labor market shows signs of weakening, the Fed may choose to continue to pause and not do anything to rates for quite some time. Now, Jim, given the outlook, your outlook for growth, you like treasuries basically across the yield curve, with the front end being the sweet spot for you. You also believe that the recent curve steepening will be a persistent trend for the next 1 to 2 years. However, you see a possibility of a short-term rebound of yields before they start to trend lower again. Now, have I represented your views correctly, Jim?
Yeah, that's correct. And I think it's very important to point it out. And our objective here is not to show the forecast, because our forecast always change. Rather, we show our thinkings behind this. What are the drivers behind, of our views? If this driver changes, our view changes, right? So it's more important to to think about the drivers we are considering, and rather than just hang on over the projection, because the projection will always change, and what the driver these changes is the drivers behind them. So by saying that, I would say, other than that, I say this is the great summary. So Henrik, maybe we can come to the end of this and just tell us where listeners can follow us.
Yes, absolutely. You can always find us by looking us up on your favorite podcast app by typing in Total Convexity, or do the same thing on YouTube. Now, please don't forget to click on the subscription button so that you will be automatically notified when the new episode is available. You can also follow us on X, where we have the handle @TotalConvexity. And you can email us at totalconvexity@gmail.com. Finally, you can follow our insights on Substack, and that's totalconvexity.substack.com. We promise never to spam your email boxes or push any products or provide any sort of marketing. All we want to give you is an honest take on the market, which may be right or it may be wrong, and we will try and make it short and sweet. Jim, anything else?
That's it, Henrik. So thank you, everyone. If you like this podcast, we would appreciate if you can pass along to anyone who may be interested. This concludes the 6th episode of our podcast, Total Convexity. See you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.